Multiples are commonly used in finance in fields like investment banking, private equity, investment management, because it's a great way to look at how much you're paying for a company compared to the return you're getting. In a way, it's not so different from how we buy real estate. If we were buying a house, for example, we would look at how much each square foot cost. Maybe we look around in the neighborhood to see what similar houses are selling at in terms of or worth in terms of price per square foot. So that's the metric. In stocks, the metric is, it might not be price per square foot, but it could be price over something, or maybe enterprise value or over something. And I'm going to talk a bit about the different kind of multiples and how it's sort of similar to a price per square foot concept. So for example, a multiple you might have heard of is price over earnings. Price is the stock price, so it's really the value of the company, but only to the stockholders. Earnings is the return to the equity holders. It's earnings per share, so it's already have interest expense deducted, so it's just the equity holders. As you can see, price over earnings is not so different from dollars per square foot. It's the same concept. Now, on the flip side, you can also do it from an enterprise value perspective, looking at enterprise value over EBITDA. And we're going to talk a bit more about why this multiple is actually preferred by most investment bankers and private equity firms. So why enterprise over EBITDA compared to price over earnings? Well, enterprise value is the value of the whole firm, so it includes both the debt and the equity holders, whereas price, of course, only includes equity value. Now, EBITDA is a great number to judge the healthiness of a business because it's very similar to operating cash flow. And operating cash flow, because it's cash, of course, is what we want to really aim for. So it's a great proxy because it's before a lot of other expenses. It's before interest expense, for example. So this doesn't penalize the company for having too much debt. In other words, it's a capital structure neutral multiple. On the flip side, price over earnings would normally go down with more debt because the equity holders would think their stocks are more risky. However, not the case with enterprise value over EBITDA. EBITDA is also before taxes, so it's not impacted by tax jurisdiction. It's before D&A, so it's not impacted by different accounting policies. In short, enterprise value EBITDA is, because it's neutral in so many areas and it's such a good proxy for operating cash flow, it's a great multiple to use.